This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers, and Mark McGrath, associate portfolio manager at PWL Capital.
Well done, Ben. Welcome to episode 309. We're actually recording this a bit early because the three of us are actually taking off for a bit of time. I'm not sure that's ever happened.
Not together.
Never happened for the three of us before, but we're not going together. No, we're going three different directions. Next week's recording this a little bit earlier. Anyways, Today's main topic, you guys want to talk about our Robo-Advisors, passive investors. You want to cue it up, Ben?
Oh, sure. Yeah. Well, I think Robo-Advisors were kind of pitched as a really easy way to access index funds. That's my perception, at least. That's the initial thing was all about that. And I don't know if that's what they actually deliver a lot of the time. Basically, there's huge dispersion in robo-advisor returns. If you look at, 5 different robo-advisors in Canada, the returns for, say, an aggressive portfolio have been materially different. So we're going to talk a little bit about that. We're going to talk about Wealthsimple specifically, because that's one that I've looked at in quite a bit of detail, just in terms of why their performance is deviated from the market. And then we're going to talk a little bit about Wealthfront, which has also done some interesting stuff. Anyway, should be all right.
And then we're going to do this week's version of Would You Rather, and that links to, would you do a robo-advisor or a active bank mutual fund?
Yeah, I like it.
Yeah, should be interesting to see what that discussion. Then, of course, the Aftershow. And then, Mark, you want to talk about fees, I think?
Well, I want to cue that up. Mark tweeted our fees. He asked, is it cool if I share our fees? I was like, yeah, I think that's fine. And Cameron, you agreed that. I think you said what did you say? Transparency is, your default is transparency or something.
And that rarely has let me down. So
yeah, right. Not? That's what it was. So Mark posts our fees on Twitter, and I think you got a pretty cool reaction, Mark. So I was hoping you could talk about that.
Yeah. It's something I've wanted to do in the past, and I just kind of forgot. And then, as Ben said, I asked you guys, are you cool if I just literally just post our fees? Nothing, no big, runway to some big thread or anything. So I posted just a screenshot of our.
And I think you even said that's the tweet, right? That's it.
I was like, these are our fees. That's it. That's the tweet. That was it. And I expected a lot of, I don't know, maybe pushback or other advisors kind of chirping us, but our fees I think are very reasonable. And I know you guys do a lot of peer analysis around our fees, and they're very, very competitive. But the discussion was really, really interesting. And most people just were like, hey, those are really fair fees. And that's totally reasonable for what you guys do. There were a couple people that thought we were what we would call advice only planners, which is where someone pays an hourly or one-time rate to receive a product, a financial plan, and not ongoing services. So I had a chance to chat with some people about why we do things the way we do and why we right now don't do any of the advice only type planning. Got a lot of people reaching out, saying can I meet with you to see if we're a good fit, or if PWL is a good fit for you? So it was just really fascinating that kind of unfiltered and unadulterated just transparency, blast, here's the fees. And I got a really good response. And I think a lot of it is just because people, I think in our business, fees and transparency have not really gone hand in hand for many, many years. At a previous firm, I asked, hey, can I put our fees on our website? And the central compliance for the entire dealer were no, not a chance. And I just found that so shocking. I was like, don't you want to just come out and say, here's what it's going to cost to work with us? What company wouldn't want to do that, right? And so by just blasting the fees in everybody's faces, I think it removed a lot of the uncertainty and maybe fear around that first conversation, and oh, they're going to lead me down this path and then hit me with this massive, fee at the end. And it's no, here it is, take it or leave it. And that was it. So it was really interesting. And I posted on LinkedIn as well. And there was some good commentary there too. So
awesome. Good for you and good for the audience.
Yeah, it was good. Like I said, I was prepared to kind of have to get defensive, and it wasn't that at all. It was really quite good.
All right.
Yeah, it is good.
You guys ready to roll?
Ready to roll.
Okay, let's go. Okay, episode 309. Which one of you guys? Ben, you taking it from here, or Mark?
Yeah, I'll kick it off, and Mark's got some stuff to say too, I think.
I'm sure we have lots of ideas around this. This is such a hot topic for so long too. If you think back to when they first came to market, 10, 15 years ago?
Well, 2015, I think, is when well, so that's at least as far back as I can find their portfolio data. I spent a lot of time on the Internet Archive for this episode, looking at like Wealthsimple's old website and what they used to say. It's changed a lot.
Fascinating.
I think a lot of the Robo-Advisors have changed a lot, which is fine. They've got to adapt their business models. We'll talk more about that, I think, maybe in the Aftershow, just about that whole concept and what people thought of it at the time and how it's evolved. But anyway, right now we're talking about our Robo-Advisors passive investors. I kind of mentioned this in the intro. I think like the pitch was definitely, and you can go and look at, like I said, Internet Archive and see what the websites used to say. It used to be all about easy access to low-cost index fund portfolios. Because at the time, like in 2015, and we had Dan Bortolani on an episode recently talking about exactly this, that back then, building a portfolio of index funds was not easy. It's gotten so much easier over time. But in 2015 and even earlier, like in 2010 kind of thing, it was not easy to just say, oh yeah, I'm going to get a portfolio of index funds or a portfolio of ETFs. That was a hard thing to do. Robo-Advisors made it easy. And that was kind of the whole pitch. But Mark, you had a post on Twitter looking at dispersion in Canadian Robo-Advisor returns. So it was 5-year data. The best return over that period was 8.48% annualized, and the worst was 4.7% annualized. Now that's like, for a service that's kind of supposed to be, passive investing, we'll make it easy for you. Why is there a 4% spread in returns for an aggressive portfolio?
Yeah. It was actually quite surprising to me. The reason I stumbled upon this is I'm writing, as we've talked about, I'm kind of Canadianizing a book for our friend Dan Solon. And there's a chapter in there on fees and robo-advisors and that type of thing. So I was looking up the returns and fees of various robo-advisors, and there was just a Money Sense article that just kind of broke it all down for me already. I was like, oh, this is perfect. I don't need to actually go and do the research. They've already done it. But I was quite stunned, as you point out, Ben. Like the dispersion in those in the bottom and the top, and the rest of them were kind of like middle of the pack. But the best performing robo-advisor over 5 years was almost 8.5%. And from my understanding, that's the purest sort of index fund style robo-advisor that's out there. And then at the bottom, you had 4.7% annualized over 5 years, and like that's a significant difference. Like investing $100,000 over that time frame is the difference between pretty much $125,000 and $150,000 at the end of the period, right? And I think, to your point, robos came out as an easy way to get a global market cap index fund portfolio, and they've had to deviate from that. And I think, and you're going to talk about this, I know, but I think the big ETF providers like BMO and Vanguard and iShares coming in and just solving this problem with a single ETF, probably, and I'm totally speculating here, the robos probably looked at that one like, okay, well now we need to do something else. Like we need to go and do something for the fees we're charging, because they can just go and buy this for 20 basis points instead. And so maybe, I'm just guessing, but maybe that's why some of them started deviating from that original kind of pitch of this is an easy way to buy a market cap portfolio. But
part of the original pitch was also the use of technology, the whole user experience. So it wasn't just indexing. That may have been the investment value prop, but from a totality standpoint, a lot of it was the user experience, the mobile phone-based app, the slick interface, slick onboarding. That was a big part of it too, which just an ETF provider, even though they might have a one decision portfolio, they can't offer the rest of that experience.
Yeah, that's true.
And they've made massive investments like Wealthsimple. I can only imagine the quantum of their investment in the technology for the client experience.
It's really good. I don't know if you guys have ever opened a Wealthsimple account,
no, it's incredible.
I opened one for my son just to kind of teach him about markets and volatility. And I did it all from my phone in like 10 minutes. And I was like, oh boy, like this is super, super slick, right? Not the managed robo-advisor portfolio. Like we basically bought XEQT, which is a global equity ETF, but the user experience is very, very impressive.
Right. And we've heard that from people saying they're more focused on that part of the value proposition as opposed to maybe they assumed it was the simple index value proposition on the investment side. Therefore, in their mind, that may be equal everywhere. Therefore, I'll go with the one that's got the better UX.
You're talking about the users?
Yeah.
Mm-hmm.
Yeah. Well, I think that's happened to a lot of people, but I also think that people have noticed that, in particular, Wealthsimple's returns have been like not great. I mean, in that list of robo-advisor returns, Mark, the lowest one, and I don't mean to pick on Wealthsimple, but as anyone that listens to the podcast regularly knows, they've come up a few times for various reasons. So I've just got a bunch of stuff that I've done on them in the past. But anyway, in this 5-year period that you had data on, or that MoneySense had data on, Wealthsimple had the lowest 5-year return. So we'll talk a little bit about why that is. But I think more generally, there are two main reasons that there is this dispersion. And actually, you even have data, Mark, on the 5-year returns of XBEL and VBEL.
Mm-hmm.
Even they have 40 basis points of annualized tracking error over that period. And those are, that's as passive as it gets. But VBEL has global bonds, XBEL has Canadian and US bonds only, and that's caused some difference. XBEL has more a little bit more in US, a little bit less in Canada, like less home country bias, and the US has done so well over that period. So anyway, two relatively passive portfolios, relatively comparable portfolios, even they can have pretty significant tracking error or tracking difference. And I think it's the same with the robo-advisors. So if you look at what's actually in their portfolios, one big difference is going to be just asset allocation. Yep. You think about like home country bias, or even just how much is in international versus US, other asset classes like REITs, and how they're allocating to that, if at all, how the stock bond mix changes. Like I looked at a couple different ones, and one of them had like the most aggressive portfolio still had 6% in bonds. So that can drive a lot of that tracking difference. And as we saw with XBEL and VBEL, very similar portfolios, but those little differences in asset allocation can make a big difference, even over a 5-year period. I looked at the BMO Smart portfolio. That's the one or Smartfolio. That's one where the most aggressive option had still 5% in bonds. And then they had 19% in Canadian stocks, 34% in US stocks, 35 international, 7 in emerging markets. And then Modern Advisor, a different robo-advisor, their most aggressive portfolio is 29% in Canadian stocks, 19% in US, 21% international, 20 in emerging markets, and 11 in Canadian REITs. Those are two, like, you sign up for these two different robo-advisors. Huge. It's huge. It's crazy.
Yeah. And we should probably also just point out before we go on that the returns that I posted and the returns we were talking about were for what we'd call a balanced portfolio. And if you look at the footnotes of that MoneySense article, they said all of the comparisons they did had between 50 to 60% in equity and I guess 40 to 50% in fixed income. So the returns that we're talking about for those particular robo-advisors, and I know you're going to get into more data, but the stuff that I was talking about at least is for what we'd call a balanced portfolio. So when you're comparing to like VBEL and XBEL, that's why you're making those comparisons, right?
Yep. Okay, no, that's a good clarification, because I will talk about different asset allocation profiles for Wealthsimple specifically, just because I had the data on those ready to go. Okay, so that's one piece. Asset allocation is going to be different, and is that good or bad? It's neither, but investors need to be aware that when they pick a robo-advisor, they are implicitly picking an asset allocation approach. And the robo-advisors will tend to have different ones. And it's not like you're just getting a good passive portfolio because you're using a robo-advisor. If you want 10% of your portfolio in REITs, personally, I wouldn't. But if you do, then hey, there's a robo-advisor that's doing that. If you don't want that, then you should pick a different robo-advisor.
Right.
But it's not like you can just pick a robo-advisor and automatically get a good portfolio. Although both of those are still relatively low-cost ETF portfolios, which is great, I guess. Maybe better than a bank actively managed mutual fund, but maybe not. And I actually have data on that too that I'll touch on in a bit. So that's one piece, asset allocation. I think that the bigger issue, in particular for Wealthsimple, and again, I'm sorry to pick on them, but it's just what I have data for ready to go, is that they're engaging in something closer to traditional active management on some level. I'm not saying that Wealthsimple's selecting securities and doing fundamental analysis. They're not, but they have made changes to their portfolios in response to changes in the market environment in an attempt to improve their long-term returns. So again, I'm going to talk about Wealthsimple and how they've changed their portfolios over time. And they've been very good about detailing their changes and explaining exactly why they're doing them. They've been super open about it, so it's not like they're doing anything shady at all. But it is interesting to see they've made all these changes and the outcomes have not been great. That doesn't mean they've been bad decisions, and I do want to talk about that. So in 2019, the big change, they added longer duration government bonds and inflation-linked bonds, and they reduced their credit risk in their fixed income portfolio. They also added low volatility stocks, and they increased their exposure to international developed and emerging markets. And then in Q3 2020, they removed shorter-term government bonds and replaced them with a mix of credit, longer-term bonds, and gold. And then in March of 2022, they switched up the minimum volatility equity ETF for a different ETF that incorporates other factors like quality and momentum. They changed their fixed income allocations back to what they were prior to the 2020 change, and they reduced their exposure to emerging markets. Lots of changes. I don't know if I captured all of them. Those are just the ones I was able to dig up.
Yeah, and those are pretty big changes, right? Like this isn't the difference between like picking one stock or the other. Like those are fundamentally different ways to think about portfolio allocation.
Yeah, they made meaningful changes. One other thing that's
tough to be a robot.
Yeah, tough to be a robot, for sure. And it's humans making the decisions. I've talked to the humans that have made the decisions, and I'll touch on that a little bit too. Now, it is worth noting also that their current portfolios, so like when you go on their website now and you look at the historical performance of their portfolios that they show inception dates of 2016. Those portfolios are also materially different from the initial portfolios when the firm first launched. So they were managing portfolios as early as 2015, I believe. And you can find in archived web pages the holdings of those initial portfolios, and they used to be very different. Like they contained actively managed funds for dividend stocks, for risk managed stocks, and risk managed bonds, in addition to having low cost index funds.
Do you know what that means? Risk managed stocks and risk managed bonds?
I don't remember. I read it. I read the pages for the funds.
Sounds good.
When I wrote this, but I wrote it months ago, so I don't remember what it. Yeah, it does sound.
You think all active portfolios are risk managed? I just wondered if it was a marketing term, if there's some like actual academic term that I didn't know about called risk managed stocks.
No, I'm pretty sure it's a marketing term. I'm sure they're doing something to manage risk, but I don't know what it is.
Does that imply there's risk unmanaged funds?
Maybe.
I think it implicitly does. Yeah, mean exactly that. Okay, so big changes from 2015 to now, but then there have been other changes since 2016 in the overall approach to portfolios. And so the question is, has this been good? Has it helped their performance? And of course, if it has, then that's great. They do post their returns, which is also very nice and transparent. They post the returns net of a 0.5% fee, which is the fee that they would charge on an account under $100,000. Then their fee is 0.4% if you're above. And they do have lower fee tiers for larger accounts too. So all the numbers that I will talk about are net of a 0.5% fee. And it is worth mentioning that Wealthsimple's customers may be getting something other than portfolio returns for that 0.5% fee, just as PWL's clients do, although they're different services. But Wealthsimple customers might get convenience, peace of mind, and if it's a large enough client to access financial planning services, then they may also be getting that. I think I don't know what asset level you can access. Do you know, Mark, when you can get financial planning?
I want to say 500,000, but I also might just be pulling that number out of thin air. And I think
is their generation level is 500,000, so that might be right.
That could be. I can see if I can look it up while we're chatting here. I think it's also worth pointing out that from what I've heard, that if you think about a firm of that size and the number of staff they have, the number of clients, I think and this isn't a knock on them at all, but the quality of financial planning service is going to materially differ from other firms, right? So what is being called financial planning, from what I've read from reviews, is often just a basic retirement projection in some cases, or like an hour a year to discuss like goals and then kind of plotting goals. So the depth of financial planning, I think, is also worth noting at least. Yep,
I agree with all that. So just to set this up, people listening, keep in mind that the returns we're going to talk about are net of that 0.5% fee, which may be paying for stuff that is valuable to people for reasons separate from portfolio returns. So we're going to look at the since inceptions in 2016 return numbers through the end of 2023 for Wealthsimple and compare them to asset allocation ETFs from iShares as benchmarks. Now, the iShares asset allocation ETFs did not exist over this full period. So for periods when they didn't exist, I have backfilled with back-tested data net of the appropriate fees for the ETF, which will give us numbers that are very, very similar to what that ETF would have earned if it did exist at the time. But it is worth noting that it did not actually exist for this full period. Now, and the other thing I want to say is that these asset allocation ETFs are not like perfect benchmarks for Wealthsimple strategy because Wealthsimple is doing different stuff as we've mentioned. But my idea here is that this is a reasonable alternative that someone investing in Wealthsimple could have alternatively invested in to get the market's returns because it's a nice, easy, single ticket portfolio. Okay, so they post returns for conservative, balanced, and growth portfolios, and those roughly map to 35%, 60%, and 80% equity portfolios. The conservative portfolio returned 2.5% annualized since inception in 2016. The iShares Core Conservative Balanced ETF portfolio, if it had existed over the full period, would have returned 4.6%. The Wealthsimple's balanced portfolio, 4.4% since 2016 through 2023. The iShares Core Balanced ETF portfolio, if it existed for the full period, it didn't, 6.14%. And then the growth portfolio for Wealthsimple, 6.5% annualized since 2016. And the iShares Core Growth ETF portfolio, 7.65%. So, I mean, big negative differences, even if we add back Wealthsimple's 0.5% fee. Even if we said that someone got a ton of value from that, so we're going to add it back to the returns.
Ben, did you do any sort of like attribution analysis? Like, can you point to a specific portfolio change that made most of that difference in the returns, or was it just a combination of things? Like, I'm just curious if it was like one kind of in hindsight poor outcome, or if it was a combination of other factors. Because it seemed to me just from reading out what you just said that the more conservative portfolios had a lot worse relative performance than the more aggressive ones. So it sounds like maybe that fixed income call in like 2020 or whatever it was might have been the big impact call.
Yeah, I think it was the fixed income call, and I did talk to Wealthsimple about this, and they showed me some data on. I think it was that fixed income trade where it was just like the trade made sense, but they just got a really bad outcome, and it really hurt. So yeah, I think you're right that it was the fixed income that really was a drag on stuff. Yeah, and then it's also worth mentioning that the 2015 portfolios, which was their first full year managing portfolios, I think they might have been open in 2014, and the first full year was 2015. Maybe that's what it was. So the growth portfolio in that first full year returned 4.7%, and the benchmark, the iShares benchmark, the iShares Core Growth ETF portfolio, 9.32%. And for balanced Wealthsimple, 1.65, iShares 7.69, and conservative Wealthsimple 0.71% versus 6.04 for the iShares comparable ETF portfolio. Keeping in mind that was, a different era basically, where that's when they still had a lot of the active stuff in there. It was a very, very different setup.
And sorry, that's just 1 year too, right? Like
that's just the 2015, yeah. Calendar year 2015.
And you're not accounting for any sort of tax drag that might have happened from those dispositions and switching, correct?
No, that's a good point. Yeah, no. And I don't know how they would have handled that. I'm sure they would have been tax aware when they transitioned to the new models, but I don't know the details there. So I sent my notes on this to Wealthsimple, to some people that I know there a while ago. I was going to make a video on it, and I still will. I got busy with other stuff. But then, Mark, you suggested this, the Robo-Advisor topic, and I was like, I actually have something written on this. We can use that. So I sent everything we just talked about. I sent it to Wealthsimple and ended up having a conversation with their CIO, who was great. He was previously at Bridgewater with Ray Dalio. He's brilliant. Like, talking to him was an absolute pleasure. And all of his explanations for the changes they've made to portfolios, you could easily argue that they're sensible, given the objectives that Wealthsimple has, which is minimizing the left tail of the distribution of outcomes for their customers, which is a perfectly reasonable objective. And like any investment decision, a good decision, which they may well have made, does not guarantee a good outcome.
Yep.
And even if you're going to get a good outcome in the long run, short-term noise, in the few years after you make a decision can make you look completely crazy, even if you've made an objectively good decision. Although I don't think that there are many objectively good decisions in investing. Anyway, so the big thing for investors to understand is that Wealthsimple, but robo-advisors in general, are not necessarily buy and hold passive in quotes, investors. You can ask Wealthsimple for an ETF portfolio. They told me this when I talked to them, and I asked if I could say this. And I said I could, which is kind of cool. But I guess if you call their customer service and say, I want a buy and hold index fund portfolio, apparently they'll do it, which is kind of cool.
Defeats the purpose, doesn't it? Like, at the end of the day, you're paying sort of higher robo-advisor fees. And if you're going to pay those fees to just get a sort of, again, air quote, passive portfolio, you can just do so with one of the other ETF providers. So.
Yeah, but you have to do it, right? Someone's got to implement it.
Sure.
Someone's got to report on it. Someone's got to do the...
But you get more than that, though, right? Like, you do get some level of advice from Wealthsimple. And I think that they are trying to build out their advice services, especially for larger accounts.
But even within maybe I'm wrong, but could you not just open like a Wealthsimple trading account?
I don't know if you get access to the financial planning services. That's a good question.
Mm-hmm.
I'm not sure.
I don't know.
I'm not sure. Anyway, someone who is using the Wealthsimple's managed portfolio service and is happy paying their fees for whatever reason could request a buy and hold index fund portfolio, and my understanding is that they would be willing to do it.
Cool.
But I don't think most of their customers would be aware of that. Another one on this topic of our robo-advisors, passive investors. A big change was Wealthfront. I don't know how big it was, but Wealthfront in 2022. Wealthfront's one of the big U.S. robo-advisors.
Yep.
They made this big announcement, and I don't know how big the announcement was. I thought it was big because I was like, "Wow, these guys are crazy." But they pulled value.
Shockwaves.
Yeah, they pulled value out of their factor tilted portfolios in 2022, and they're to quote from their statement, they said, "We'll no longer use the value factor in our service, as research suggests it is no longer as effective as it once was." Uh-oh. I can't help but laugh there. Now, I don't know if there's ever consent. And they're talking about price to book specifically. I don't know if there was ever consensus that value stopped being effective. I think there were obviously people who did think that for a period of time, and maybe still do. But since January 2022, value has been pretty great. So I don't know. Maybe this was another case of a good decision with a bad outcome. I'm not sure. But if I look at the value premium measured in USD, because that's where Wealthfront is, from January 2022 to April 2024, value premium, so value minus growth, in the US, 1% premium, EFI 6.7% premium, emerging markets 9.55% premium since January 2022 through April 2024. Yeah.
Sorry, does international include? Oh no, it's EFI. I guess you have Canada as well.
I didn't include Canada in there just because I don't think Wealthfront cares about Canada, but
fair enough.
I do know that the value premium over that period has been very positive for Canada too.
Yeah.
It might actually be the highest premium of all those markets over that period.
Yeah,
wow, really?
Yeah.
I may have that somewhere. No, I don't have it open. Now, I do also want to say that PWL is not purely passive either, like in the sense that we're not just holding market capitalization weighted index funds and doing nothing. We tilt towards small cap and value and profitability, and we're using dimensional funds, not index funds. So we're doing different stuff too. And in a lot of cases, it has underperformed just buying index funds because value has not done super well although it has done very well recently, just over the last 10 or so years, it has not done very well. But I think a big difference is that we're not making changes to portfolios much over time. Like I've been here for more than 10 years now, and we've been doing the exact same thing the whole time, other than maybe adding profitability, dimensional adding profitability, and more recently adding short-term reversals to the strategy. But it's like big changes, like we're going to overweight emerging markets, or we're going to, materially change how we do fixed income. Those, although Dimensional has added some more credit to their fixed income portfolio since I've been here. So they're having little changes, but nothing big and nothing tactical, like nothing in response to what we think is going to happen or what Dimensional thinks is going to happen. It's like small updates incrementally based on pretty serious research, as we heard about from Wei Dai in a recent episode.
Even look as COVID rolled through and the markets roiled in March of 2020. I mean, if you were in a 60-40 or 70-30, that was consistent. Even on those days where the market moved 10%.
Yeah.
And your 60-40 became 55-45, they're automatically rebalanced. I mean, you stuck to the rules, and that's where, to me, these kinds of asset allocation tools really show their value, because it's automatic. It just takes the subjectivity out of the advisor's hands.
Yep.
Because it would have been very easy during that period, and we all remember it. It would have been super easy just to let's just wait and see. We'll keep a lower equity position. We'll see how it looks. And you could have missed easily that charging snapback that happened, late spring, early summer of 2020.
Oh, it's so hard to do, like as a human. Like it's so easy to pick that out in hindsight, right? And say, well, I would have bought here, I would have sold here. Like it looks obvious if you just look at the chart. But as I call when you're at the hard right edge of that graph and things are down, like I was opening the markets and every day it was like 10% down. And everybody has a trigger point, right? Where it's like, okay, enough's enough. We're going to rip off the Band-Aid. And being able to kind of systematically take that decision out of your own hands, even as an advisor, as an investor, I think is, to your point, it can save you. It's like insurance against massive potential mistakes.
Right.
Yep. Yeah. So I did want to throw that out there, that I'm not trying to say that we're better than Robo-Advisors because we, are perfect market cap weighted index investors. That's not the point at all. But I think it really just highlights that investors have to understand what it is that they're investing in. As I say, we could have had the same conversation just now about asset allocation ETFs or about index funds more generally speaking. Like you can't just take index funds and assume that you've got a good portfolio, because you could have really bad index funds. And I'm not saying that Robo-Advisors is bad. I'm just saying that Robo-Advisors are going to have different portfolios, and they're not passive and they're not objectively good investments. So you got to know exactly what you're doing. But that whole idea that a truly passive portfolio exists I think it's just a flawed premise from the beginning. Every portfolio, including index fund portfolios, as we just saw, contain a whole bunch of active decisions. That was lesson number 18, I think, in our most important lessons in investing episode that we did. There's no such thing as a passive investment. There's the spectrum of passive and active, but nothing is truly passive. And because everything is active on some level, you've got to understand which active decisions you're making and why. And it's the same thing when you're delegating those decisions to, in this case, a robo-advisor. You've got to understand how they're managing the portfolio, how they're approaching asset allocation, how they're making decisions about changing asset allocation over time. Those are all really important. And so I think the answer to the question, are robo-advisors passive investors? I would say, well, nobody is. So no, they're not, but that's not necessarily a knock against them. I think it's just it highlights that even with robo-advisors and with index funds and with human financial advisors and all that stuff, but I think robo-advisors have this image of being passive. So you've really got to evaluate how they're approaching both asset allocation and changes to asset allocation over time.
I don't know that the average investor is going to understand that either, right? Like to your point earlier, as this kind of starting as an index fund portfolio or a cap weighted index fund portfolio, I don't think it's obvious to a lot of people who are signing up with a robo-advisor service what they're getting. And the questions that you mentioned they should ask are all obviously very important, but I feel like the amount of financial literacy it takes to understand that would be such that you wouldn't really want to potentially a robo-advisor in the first place, outside of some of those other benefits that you talked about earlier, Ben. Right? Like if you're at the point where you're able to kind of analyze their portfolio decisions as an investor, like you're probably better off just either putting the portfolio together yourself or buying one of those one fund solutions. So I think like a lot of the average investors who bought the robo experience thought they were getting that sort of broad-based market exposure, and they didn't. And had you picked, say, Wealthsimple versus somebody else, your outcome was totally different as a result of it, right?
It's really interesting. You'd love to know the psychographics of the typical new client going into Wealthsimple, because I'm hearing that they're having tremendous success getting new clients of late, like in the billions, which is great for them. But what is that profile? What is that key value prop that they're coming to them for? Is it the user experience? Is it indexing, in air quotes? Is it passive? Which, as you guys know, I find such a loaded term, and everybody has a very different definition of what passive really means.
So while we were chatting, I did look up the pricing and features for Wealthsimple. And from what I can gather just on the pricing page, you get the same benefits regardless of whether you're with the robo side or the self-directed side.
Okay, nice.
Cool.
I don't see a delineation between the two in terms of the services that you can avail yourself of. It looks like it's just based on assets. So we were talking about financial planning earlier. And so if you have $100,000 in assets, you get check-ins with an advisor, which is kind of like the lighter planning that I was talking about. But interestingly, at the generation level, Ben, which you said is at 500,000, you do get what they're calling financial planning, and that could be saving strategies, investment education, tax planning, retirement planning, estate planning, and insurance analysis. So I'd be really curious, actually, if any of our listeners have gone through that financial planning experience at the generation level or not. I'd be very curious to see what they thought of it. But I think also, Cameron, to your point, like Wealthsimple does a ton of cool stuff. Like if you just look at all the features and benefits, and some things that, or maybe just more marketing than other things, but things like stock lending, like people are going to want that. People are going to want to see if they can quote unquote juice their returns by participating in like stock lending programs. And they have 5% cash, 5% returns on their cash accounts, which act like a checking account. Like these are really cool things. So it doesn't surprise me that they're seeing a ton of success in that.
Did they bring back the VIP lounge, the airport lounge passes?
So at the generation level, it says you get 10 passes per year. We've partnered with Dragon Pass to offer you and your guests 10 airport lounge visits per year, available at over 1,300 locations worldwide. So you need to have $500,000 with them, but these are really cool little perks, right?
Very cool.
Yeah.
When you're talking, Mark, before you started talking about the services stuff, we were talking about what a sort of low knowledge investor would expect to get, and kind of whether picking a robo-advisor would have been a good thing or not, which ties into our would you rather question. So I think we can go there now. Before we go to the would you rather question, I do want to highlight that over that 2016 to 2023 period that we talked about for the Wealthsimple versus iShares returns, the RBC Select portfolios, which are traditional actively managed bank RBC, in this case mutual funds, their conservative and balanced portfolios outperformed the corresponding Wealthsimple portfolio. Wealthsimple has the edge in the growth portfolio, but the bank mutual funds, even net of their relatively high fees, actually did better. So, with that context, would you rather put all of your money with a robo-advisor? And I know robo-advisors are broad because you could just pick like, hey, the one that actually does the index fund portfolio. So maybe it's too easy of a question. I don't know. Would you rather put your money with a robo-advisor? Maybe one of the robo-advisors that has a history of making these sort of tactical moves. We'll do that. Would you rather put all your money with a robo-advisor or in a big bank, actively managed mutual fund?
Robo-advisor, hands down for me. I like the progressive nature of this. I like the value prop they're bringing. They're shaking up technology. I think I'd behave well in that environment. So maybe I'm a bit biased, but I think it's cool. It's cool technology, progressive, and the banks. And as I said last episode, I love the bankers I work with, but they make enough off me. And I now, having said that, to your point, Ben, about the RBC Select portfolios, I think there's some great behavior biases that can be built in if you're kind of because I'm sure there's a lot of people who just put all the money into one of those funds and just never look at it, right? And I've had a terrific long-term experience. So if you can set it and forget it, behaviors we've talked about many times will trump your returns over what the ultimate. So if someone can behave better with the RBC Select portfolio, beautiful. What caused the outperformance recently? We could speculate, but it doesn't really matter. So that's what I would do. Mark, what do you think?
Interesting. No, that's a good answer. And I'm glad you brought up those portfolios specifically, Ben, because my answer was going to comment on the fact that a lot of these massive bank funds are basically closet index funds at this point. And I think RBC specifically, I might be wrong. I think there was a lawsuit at some point. It might have been TD, I'm not sure, but I think there's a lawsuit at some point against one of the big banks for closet indexing. And I don't know that they won or lost the lawsuit, but I think it's relatively well known that when you get to a certain size, like the RBC Select Balance portfolio, I think is north of like $50 billion. And it's hard to do much but become an index fund at that point. So from that perspective, those big bank funds, yes, they have higher fees, but if they are more traditionally really an index fund versus lower fees for active management, I think that makes the decision really, really difficult. And Cameron, you made a good point, which is these new technologies like Wealthsimple, the user experience is really, really slick. But from a behavioral perspective, it makes it super easy to just like go online and make a decision. And I think that's less true if you don't have that technology at your fingertips. So my answer is actually probably a big bank fund, but it wouldn't be like one of the sector funds or something. I would pick probably one of these big bank closet index funds.
Fascinating.
Yep. So that I think that lawsuit, it was a class action. It was against TD, and it has been dismissed in a bunch of different courts, I think. I don't know. BC. It was dismissed in BC. Oh, it was BC again, yeah. So it looks like it's gone to BC court a few times and has not gone through as a class action, which means nothing's actually happened.
So Ben, you get to be the tiebreaker.
Okay, so
Here we go.
the closet indexing thing, I 100% agree with, and that was actually what I was thinking as well. That, like, hey, if you can get a consistent equity exposed portfolio with like an RBC aggressive fund or whatever, that might be better than a robo-advisor that's going to do a bunch of weird stuff like add gold to your portfolio. So in terms of consistent asset class exposure, I might actually prefer the bank fund. Now, maybe not for me specifically, but more generally speaking, there's a paper from a professor at a Canadian university. I don't remember which university he's at.
See, Mark, he's got a paper to back up his answer. We have to up our game the next time we do this.
Sorry, guys.
Like we need better game, Mark. We had to gang up on him 1 week.
Yeah, we're gonna have to collaborate. We're gonna have to collaborate
take
beforehand.
both our heads to compete here.
Yeah.
Was I not supposed to bring papers to this conversation?
No. I'm just
We
saying,
always
we're learning.
We always expect you to bring papers to your conversations, Ben.
Okay, so
Some
there's
week we'll catch you.
There's a paper called "Are Banks Better Money Doctors?" and it speaks to, Cameron, I think what you were saying. So they look at an analysis of mutual fund flows of bank and non-bank mutual funds using Canadian data. So super relevant, obviously, to this conversation. High-level findings. Relative to non-bank funds, bank funds have lower flows on a monthly basis. They also have lower flow sensitivity to performance than non-bank funds. So investors in bank funds are reacting less to performance. Usually what you would see is after good performance, investors pile into a fund. After bad performance, they pile out. Or not necessarily pile, but they're sensitive to the performance. The flows are sensitive to the performance. And what this paper is showing is that bank funds flows are less sensitive to performance. And they find that that effect is largely driven by lower outflows after poor performance. So the bank fund does poorly. People don't bail as much.
That's the beautiful part about the bank's business, right? People are there because of the bank's brand. And like the Canadian banks have been around for over 100 years. So you've got that built-in loyalty, which just makes such a beautiful, consistent, like if you're, like I'm TD Green, right? Like you're green.
Yeah.
You just are.
Yeah.
Amazing businesses.
Yeah. And this effect mostly exists in equity funds, less so in balanced funds and not at all in bond funds. But anyway, if I had to pick one, I I'm probably going with a bank fund too, Mark. Same as you.
Nice.
Okay.
I can see
You know
the
who's not going to
disappointment
like
on your
that?
face, Cameron.
Jason. Jason's going to be furious with us for saying this.
Jason Pereira?
Yeah.
Yeah, he will.
He's not going to be
Absolutely
impressed.
will. We should bring on our friends to answer these questions. The Would You
that's
Rather
not a bad
game.
idea.
It'd be cool to have a
Yeah.
guest come in and
That would actually be pretty funny.
yeah.
See if we can get Jason to come out of his shell.
Yeah. I don't think that'll be too hard.
Hard to get an opinion out of him.
Oh yeah, totally.
Okay, you want to go to the after show and we'll keep talking robos?
Yep.
Sure.
Let's go.
So, do you guys remember when the robos came out? There was this wave of fear that came across the industry. And this is something that Michael Kitsis, who's a commentator, for those who aren't in the business, he's a very high-profile commentator on our space. And he was in the camp that they're not going to have a huge impact. But there's a lot of fear that's going to put massive pressure on fees, especially if you're in the AUM, fees based on assets, business model. And the reality is that the fees have not come down hardly at all over the past decade, but the amount of services and value being delivered has gone up. So people have to do more to justify the fee is the punchline. However, there is a lot of money going into this space, like the robo space, and kind of circumventing the independent advisory model, which I think is super interesting. And but in terms of, is it having a big impact? So I watched a presentation by Chip Rome of Tiburon Advisors, which is an advisory firm to advisory firms. And the scale of our industry worldwide is absolutely massive. Like it's over $150 trillion in size. It's a wealth management, liquid wealth management space globally. Wow. So one of his points that he was making is that even Fidelity, which is like the largest at 10, 11, 12 trillion dollars in a $150 trillion marketplace is still relatively small. You're not talking about massive amount of market shares. So his point was everybody is relatively small. But certainly one of the big trends is this shift from active to passive. And if you're an active manager now, you've certainly got the headwinds against you from this massive shift towards, call it passive or index type investing. I thought that was pretty interesting when you think about the scale. Like even Vanguard at 6, 7, 8 trillion?
Yeah,
right?
I think BlackRock's around 10, I think, maybe just north of 10. So yeah, even between the three of them, they have, call it less than, a quarter of the global market share?
Yeah, far
Based
less.
on those numbers, yeah.
Based on those numbers. And he said those along with Morgan Stanley, those are the giants that are. But the other comment that he made is that there's very little new money coming into the system. The whole system that we're in, there's roughly 2% growth, organic growth coming into the system. So most people are kind of trying to chip away at each other's clients, right? And and that's really what's going on at scale right now.
Wow, that's interesting. It's funny you mentioned the just the size of the market and the size of the active versus passive marketplace. And I actually took this information from the what's it called, the PWL Active Passive Fund Monitor. Ben, is that what you guys call it? Thanks. Because I was writing this for the book as well. So and the U.S. is way ahead on this. But in the U.S., passive index assets have now actually surpassed the value of actively managed assets. In Canada, though, 83% of the marketplace is still actively managed products. So the Canadian marketplace at the time that I read this, the active passive monitor was just over 2 trillion, I think it was. So somewhere around 2 trillion, and passive index type products were about 310 billion versus 1.575 trillion in active funds. So we've got a long way to go before there's like even a seismic shift or a tipping point.
These are fund assets. There are like other non-fund assets that might change these numbers, but this is like mutual fund and ETF assets.
Yeah, well, you'd think non-fund assets would skew towards active anyway, right? Like if
I don't know if that's true, because a lot of, like, if you go to the institutional world, you can very easily have an institution who is managing their portfolio very similar to an index fund, but they're not an index fund because they're holding the securities directly.
I see what you mean.
So,
interesting.
Yeah, I think there's probably more indexing than you might expect in the non-fund portion of the market.
Very interesting. Yeah, Cameron, to your point, I remember in 2015 when Robo-Advisors were the big boogeyman, and there were a lot of people that were like advisors that were really scared that this was going to be so disruptive. And you'd hear it from people too who just don't like advisors. Like your days are numbered, and like the robots are coming for your job, kind of thing. And obviously, in hindsight, that was kind of laughable. But we're experiencing it again now with AI and ChatGPT, right? Like people on Twitter just chirp me all the time, like you're like a robot's taking your job, you better go apply at Starbucks, kind of thing. And I don't know, and this doesn't even just apply to financial advice. I don't think the market for human advice ever disappears completely. Like whether it's tax or financial advice or legal advice or fitness advice or whatever it is. Like I think there's always a market for humans wanting to interact with humans. And sure, maybe the technology gets so good that at some point you can't tell. And I think if nothing else, that will increase it will focus the business into those who offer higher quality services. So it might kind of trim from the bottom. But even with AI these days, I'm not yet worried for our industry or my own job.
Humans are so messy. And AI is going to help us better help humans. But humans by nature are messy, right?
Yep.
And financial planning is booming. That's the big shift, right? I think we said this a couple of weeks ago. Back in the day, threw in financial planning for free to manage the assets. Now, effectively, Ben, as you say, investments are largely figured out, and the value prop is more shifted towards the financial planning side. And that's exactly what Kitsis has been saying.
Yep.
Super interesting. Ben, what do you think?
Yeah, I think there've been a bunch of cases where everybody thought advisors were going to be done. Like I think even with discount brokerages, everyone's like, well, advisors are done, but the business just evolves. Like what an advisor does changes. You used to place stock trades, and then discount brokers show up, so that's no longer valuable. So the business model shifts.
Yep.
I don't know what the next shift will be. I don't know if Robo-Advisors changed much other than maybe, like you said, Cameron, it didn't compress fees at all. It maybe pushed people to improve their services, maybe to improve their online offerings. I don't know how much it changed the actual services, though. Maybe a little bit more planning. But with AI,
What about the general awareness of just a non-bank or non-large firm option for your investments and financial planning? I think there's a lot of people don't even know that firms like us even exist, that this is possibly an option. Like how can you go outside of the bank in Canada or the big
even
brokerages
people that
in the
know
US?
Us, like your experience on Twitter, Mark, even people that know us don't necessarily know what we do.
Yep. Well, and that's largely like Questrade's whole marketing program is it Questrade who's basically like, oh, you're still using Dad's guy? It's like,
Questrade,
you didn't know that there was another option, right? So I think to your point that even just letting people know that that's not the only way to have your money managed, whether it is through like discount brokerages or robos or kind of independent firms. A lot of people have been with the banks, as you pointed out, Cameron, for decades. Their family's been with them for decades. The loyalty is there. A lot of bank advisors, do great work, but maybe just educating Canadians that there are other options. I think that the robos probably helped accelerate that.
Yep.
And speaking of value prop, I mean, what's up with the new calculator? Can you give us an update?
Yeah, well, so I wanted to actually talk about that in the context of AI as well. Just to your comments, Mark, about whether AI is going to take our jobs. I think it can maybe change what we do, like some of the other stuff that we've been talking about has. But, this new calculator that I'll talk about in a second, Cameron, I tried to use AI to help me code it, and it was absolutely horrific.
Really?
Like completely useless, in fact.
Would you use?
I talked to Jason Pereira about this, and
Would you use ChatGPT to help you write the math and the code and stuff?
Yeah,
okay.
Yeah. Because Jason Pereira told me to. So yeah, I'm coding this thing in VBA. So I would just use ChatGPT to do it. I said, okay, I'll try that. So tried a bunch of different prompts, and the code it gave me was like a joke. And maybe I was doing it wrong. I don't know. Maybe someone who does software for a living is going to tell me that I was, it's my fault, not ChatGPT's. But anyway, it didn't impress me. So for that type of stuff, for modeling complex financial decisions, I'm optimistic. Maybe it'll get there. Like I think technology is great, but at least for now, and I know it's moving fast, but for now it's not there. The new calculator that we go ahead.
No, I was just gonna say I think it can help with a lot of basic questions that don't involve the modeling, the math, that type of thing. Again, in Dan's book, there's at the end of the book or at the end of one of the chapters, he basically said, I asked ChatGPT this question and here's its response. And it was a very, very simple, like 5 questions, like should I pay off debt or should I invest? And like what debt should I pay off first? And these types of things. And it answered those questions really well. So like general logical reason, I think, is pretty good. But yeah, from what I've heard just from watching like programmers and stuff on Twitter, it's got a long way to come before it can do that kind of stuff that you're talking about.
Yep. So yeah, the new calculator is, we had that break-even calculator that for personal investments. So if you own a taxable asset with a capital gain, we built a calculator that people can see online that helps you understand how long you would have to hold that asset to make deferring your capital gain more advantageous than realizing it before the capital gains inclusion rate increases. So that's been out for a while. We did that one pretty quickly after the federal budget proposals were released. More recently, we added to that calculator a little toggle button where you can switch between personal and corporate investments. So now you can look at a corporation and you can see, again, what is your break-even horizon with the corporation. What we've left out of that model is the ability to include how you're paying yourself from your corporation. We talked about this in a recent episode where I kind of talked about some of the modeling that I've been doing on this. We may include that later, and it does matter to the decision. Like you would make a different decision if you're taking a certain amount of money out of your corporation with respect to realizing a capital gain than if you're not taking any money out of your corporation. But it's also a lot more complicated, both to model and to kind of show what's happening in the outputs. So we've done that modeling. We may release it in our public tool, but for now, we're just going to keep that portion of it as an internal tool.
It's pretty cool though. Like I've gone through the internal kind of training on it, but yesterday Ben helped me use that calculator in conjunction with the financial planning software that I use for a particular client who needs to make this decision. And Cameron, as you mentioned, we're all going away, but I leave tomorrow. I come back June 24th. And so I booked this trip, of course. And then they propose the changes. I'm like, great. I literally come back like the evening before the changes are going to go into effect. So for my clients who may be affected, I've had to kind of figure this out before tomorrow. So Ben helped me with the calculator, and it's quite impressive. Like the amount of thought that's gone into it, and just the way it presents sort of where the break even is, and how sensitive it is to some of these inputs and expectations. Right. So it's just such a complex decision, I think, for a lot of people, that without this type of modeling, like there's going to be mistakes made around this for sure.
I think it's unfortunate how this whole thing's coming down. I'm not even talking about the policy, but it's more the rush and the timing and the complexity around it. This is very complicated stuff. Mm-hmm. Also for the tax department too.
Oh yeah.
Very complicated.
It's complicated when we have no legislation, no draft legislation to go on. So it's like capital gains rates increasing, but we have 0 details on how it's going to work or whatever. And that can change what people might want to do. So it's a really, to me, it feels, I don't want to get political at all, but it feels irresponsible.
Well, we're living it, right? Client situations, other professional situations. There's this massive rush to come up with an answer. You're basically flying blind. So, yeah. Good to move on, Ben. You want to talk about private credit and some of the feedback you got in the community?
Yeah, I will mention that. I do also want to say that we did do a Money Scope episode, Mark South and I, on some of the stuff we just talked about. So we talked about the modeling that both Mark South and I have done on capital gains and corporations. We talked about individuals too. But that episode came out last Friday, I think, when this episode comes out. Is that right?
Yep.
Anyway.
Nice, basic, easy listening stuff.
Yeah, that was a pretty intense episode.
Just good background chatter.
Mark South was very excited to have his first 3D chart that he's ever made, because that decision requires 3D graphs to understand what is happening.
That sounds like something he'd get excited about.
Oh, he was excited. I was too, though. We were both super excited.
Yeah.
Private credit. So I mentioned in a previous episode that someone had reached out who had worked in private credit for an insurance company, and they'd kind of shared some of their experiences and given some feedback in the episode. Somebody else in the Rational Minded community, they identified themselves as a private credit fund manager. Obviously, they're anonymous, so I can't verify that, but based on their comments, I believe it. And at the very least, their comments are pretty interesting. So I'm going to share those. So they said that the payoff in private credit is like selling a deep in the money covered call. And so he said you can refer to the prior Rash Reminder episode on that topic. All the points raised there when we talked about covered calls apply the same to private credit. So it's pretty interesting. And another parallel that they thought about was it's like private credit can be a lot like dividend investing, where the appeal is high distributions and the twisted benefits, less focus on capital gain. They said that you should definitely disregard the Sharpe ratio for private credit because returns are highly negatively skewed. You've also got limited upside, which reduces standard deviation, which is a double benefit for the Sharpe ratio. So I had talked about the smoothing being a reason to disregard Sharpe ratio, had not thought about the skewness. That's another good reason. So that makes talking about Sharpe ratios for private credit even more ridiculous than I thought. Then their last comment was that smoothing as a service is a real thing. Some investors ask for it. Others are mark to market only. But I thought that was pretty interesting. That some people will actually ask for, like they want the smoothing. So the concept of smoothing as a service is a real thing.
Oh, anyway. For sure it is. I talked to somebody on Twitter yesterday, and I was talking about volatility or something, and somebody came in and commented, and I'll butcher the quote exactly, but it was something like, "Oh, I hate my manager. He never has those like plus 30 years. He just gets me 7 to 8% every single year." And I was like, "Oh, it's probably a bunch of private credit and private equity and real estate and that kind of stuff." And so I didn't dig into it further. But to your point, like that individual was obviously being sarcastic. They loved this steady 7 to 8% every single year. So for them, it really was a feature, not a bug. And actually at the FPAC meetup, the Financial Planning Association of Canada meetup in Vancouver a couple of weeks ago, I talked to another advisor that I know, and he works for a firm that does a lot of these private assets. And so we had a brilliant guy. His background, he's a mathematician by background turned advisor. And he fully recognizes that like clients do want that return smoothing, and it might lead to better decision making. And he felt like he's kind of at a crossroads, like, is my obligation to the best client outcome, and if that return smoothing can provide better outcomes and better decision making, then I actually do kind of owe him a duty to use these types of products. So either way, it was a really great conversation, and I can see why some investors want that type of smoothing as a service, as you put it.
This is something Morgan Housel talked about with Shane Parrish on the Knowledge Project a couple of weeks ago, was exactly that. Like, I don't pass judgment, he was saying, on how other people invest. If it works for you and you can stick with it, so be it. You have to find what works for you.
Well, this is why I
happen to be a Vanguard guy, ETF guy, 100% with a lot of cash. That works for my family, but that may not work for you. You may have a need to have an active portfolio or some other type of portfolio.
Well, and that's why when I win my $1 billion, it's all going into whole life for that steady smoothing effect.
Exactly.
Right?
Yeah.
It's a benefit to me.
Had a nice, someone reached out to me on Twitter today, actually. Garrett reached out to say it's been a long time, but only one episode left to go in his binge of listening to all past episodes. And the final one was our conversation with Morgan Housel about his new book, Same as Ever. So that was pretty cool to binge them all in a relatively short amount of time.
That's impressive.
Read the next one, Mark.
It is not. Yeah, I will. I will just say it is not easy to binge the Rational Reminder. Like going back, I often tell people who are new to the podcast, like go back to episode 1. But we're recording 309 today, and some of them are long, and some of them were like very deep. So it's kudos to Garrett for binging on this.
Seriously.
Yeah. And episode 1 was pretty rough.
Yeah, things have improved since then for sure.
I thought a picture, Ben. Did you ever see that picture of you and I in the room? I think we took that picture during episode 1.
Oh yeah.
Yeah.
I don't know. I haven't seen it.
You're giving a presentation next week, so I'm including that picture and a bunch of other stuff in the presentation.
Nice.
You should share it on the forum. I'm sure people get a kick out of it.
Yeah, you should put it in the YouTube video for the episode.
There you go.
I'll get it to the team.
So the next one's from Shomik in Vancouver via email. As a fellow Canadian, it's great to have such a nuanced, intelligent, and in-depth financial podcast that has intelligent takes on indexing, CPP, financial planning, interviews with Nobel Prize winners, and the general tenure of the discussion being focused and helpful to the average person looking to do well in work and life. Very nice.
Very nice.
So I actually replied to that email from Shomik, and he replied back with a whole bunch of commentary. I guess he's been binging episodes too, but he had like notes and comments on, I don't know, 5 or 6 episodes of stuff that he found interesting. It's just like, I replied back to him saying like, I find it super interesting to hear people's thoughts when they've recently listened to a whole bunch of the episodes, because I can't keep all this stuff in my head personally. And so when someone goes and binges a bunch of stuff and comes up with like, based on these 17 episodes, these are the insights I have, I'm like, wow, that is so cool. There's a bunch of good discussion in the community from our last episode with Just Us, when my least prepared episode ever, personally, that turned out to be a great episode that a lot of people seem to really enjoy. Sparked a bunch of good discussion on buying versus leasing a vehicle, also on how much life insurance you need. So lots of good discussion in the community on that. Someone in the community asked why I prefer leasing. So I kind of thought about that for a bit. And I had some notes that people might find interesting. I like being covered by the manufacturer warranty for the full period that I have the vehicle. Because if you have major repairs, you take it back and they fix it. And that's like, it's it. I like having a known floor on depreciation of the vehicle. We talked about that, I think, in the last episode on this too. Although I did mess that up by going over my allotted mileage, my last lease, but I'm not going to do that again. I got more mileage this time.
Did you have to pay a penalty per kilometer on that?
Well, no, they called me because they could tell I was going to go over. And so they said, listen, if you keep driving at the same pace you're driving it now, you're going to owe about $5,000 at the end of your lease term.
How do they know that?
I guess I'd taken in for a service, maybe. I don't know.
I thought they had like
must be that. I don't think they were watching.
Yeah, they're like monitoring your driving. Okay.
I don't think they were monitoring.
So they wanted you to flip it while the value was still higher, even though you had term left on the lease. Interesting.
Yeah, so it was like a reduced buyout of the negative equity.
Yep.
Based on, like, I paid less than I would have paid if I kept driving the same vehicle. And they've rolled it into the new lease, which was financed at 3.99%, which that's like free money basically today.
Was the monthly payment materially higher? And not specific numbers, but the monthly delta?
It was a bit higher. The leasing rate was higher. I think it was like 1.59 in my last lease.
Yeah. Okay.
So the interest rate was higher. The MSRP on the vehicle's gone up since the last one. So yeah, payments
As have the
up.
residuals, but you increase the mileage, you may have decreased your residual.
Yeah, increased the mileage, and we had that negative equity that we
Yep.
were rolling in, so the payment did go up. I like minimizing the negotiation at the time of purchase. I've done 2 used vehicles in my life, because that's like, that's supposed to be the good financial decision where you buy a used vehicle and there's less depreciation. Did that twice, and you've got to negotiate twice. Like you've got to negotiate when you buy the vehicle, and you've got to negotiate again when you later sell the vehicle. Whereas lease, you just take it back. Another big one is I'm not a car person. You said the same thing, Mark. The information asymmetry concerns me. I don't know what I'm doing. And a new vehicle in warranty with no end depreciation, like that just mitigates me getting screwed basically. I also like new vehicles. I mean, I could just be the argument. The new vehicle that we just got is a lot nicer than the previous one we had. It's got great new features that I like. And then maintenance issues. Like the 2 used vehicles I had, each one, they weren't super old or anything like that, but each one had major issues that I had to deal with while I owned it. And I've now done 2 full 3-year leases and not a single issue. So I don't know.
I'm sold.
Yeah, right?
Yeah, sounds great. We bought our last car, as I think I might have mentioned.
Yeah.
And to your point, I just hate cars. We have one car. It's 5 years old. Like, I will drive that thing into the ground, I think. But when the time comes, I'm now sold on leasing. So thank you for that.
Good for you. So we got notes down here. You and I, Mark, both watched separately, but we watched the Ashley Madison story on Netflix. Is that an unbelievable story? I didn't realize it was a Canadian, Toronto story.
Yeah. So my wife watched it. I didn't watch it. My wife
Oh,
watched it.
you didn't watch it. Okay.
My wife has this tendency, bless her, I don't think she listens to the Rational Reminder, so I can say this safely. She'll watch something, and then she'll be like, hey, I watched this thing, and it will take her just as long to explain the thing as if I were to just go and watch the whole thing myself, right? Like if I watch a documentary, it's 2 hours long, I'll give you like a 5-minute recap.
Yep.
She'll spend like an hour going through like every single detail of it, and sometimes I have to cut her off. I'm like, look, at this point, we may as well just go back upstairs and watch it together because it's going to take you 2 hours to explain the entire documentary. So she gave me like the whole 9 yards, the whole play-by-play on it. So I didn't watch it myself, but I may as well have because of the way she explained it.
It's crazy. I mean, this is ahead of AI too, and you can only imagine Ashley Madison in today's world and how it can be. I mean, it was manipulated massively to get more largely men on the site, and the information they would capture before the breach is just incredible.
Yeah.
37 million people were on that site.
Yeah.
With this dream, life is short, have an affair. Like, wow.
I remember when the breach happened too, because it was big. It was big news at the time. And I don't know when it was. It was probably like 2015, 2016 or something like that, the actual data breach happened.
Yeah.
And I remember I was at a concert or something, and I saw, like, I was scrolling through news waiting for the main act to come on. And I was with my wife, and I was just like, oh, this is bad news for a lot of people. And we had a discussion about it then and there, and it was the first time she'd heard of that particular company. But she remembered that when the documentary came out. She's like, oh yeah, Mark told me about this like a decade ago.
It's wild.
Yeah.
I take it you haven't watched it, Ben?
No, honestly, I've been it's a good thing I'm going on vacation because my attachment to Excel has become a problem. Like legitimately, like I need to stop modeling stuff for a bit.
You're in love with it instead of just loving it. Like it's
I don't know,
personal.
man. I can't. I can't stop modeling stuff. But I think we're at a place with our model now where there's only one big piece left. But the thing is, like, it's for the capital gain stuff in a corporation that we've been talking about. But we see so many more use cases for that model to give like really, really efficient, high quality advice to clients. And it's just like, there's always just like one more piece we have to finish to make it that much better. So,
plus the three of you are feeding off each other. You, Dr. Mark and Braden. I mean, I can only imagine that fuel going around.
Yeah. So I think while I'm off, and I'm not gonna bring my computer or anything, so I'm not gonna be doing any modeling. But Braden's gonna try and finish the last big piece, and then once that's done, it should be at a point where the rest is just like refinements and tweaking and front end, as opposed to like actually building the modeling engine. But getting to the point we're at now has been, I don't know, man. I get sucked into my work often anyway, but it's just been on a different level with this thing. I don't know why. Like I could see the value that it would ultimately add, maybe, or maybe I was just making like good progress every day, and it was just kind of in a good flow state. But I have not sat down on my couch in my living room for like weeks.
It's probably just the sense of urgency too, right? Like knowing that this deadline's coming up, so you've got this shrinking window of time where this is going to be of value, right? Like it's crazy the amount of work that you guys have put into it, knowing that if this goes through as planned, post June 25th, like the whole reason for this thing was to make a decision around capital gains today, and post June 25th is this. Again, there's lots of other applications, I think, for the calculator, but this is really centering on one decision for a subset of Canadians, and you're just pouring your heart into it. It's wild to watch.
Yeah, well, it's an important decision, and I think it's an example of something that we can really add value on in terms of helping people make a good decision, and a decision that a bunch of people have to make. But I think if we weren't as excited about the other applications for the kind of modeling engine that we've built, it wouldn't be quite as interesting. But because it's going to help with this one sort of acute problem that a bunch of people have, and it's going to be something that we can build a bunch of really useful derivative tools from, I think that's made it just really hard to stop looking at.
Can you say you're addicted yet? Like, is it getting close?
I didn't want to use that word because I didn't want to offend anyone, like that's one of those words that
fair enough.
Is like kind of sensitive, but yes, that's how I feel. It's hard to stop. I need to, I've been going to the gym because if I don't sleep well, but it's like I'll work until 8, go to the gym, and then basically go to bed, wake up the next day and open Excel.
Crazy.
Sounds like a dream world.
A nightmare for me, but
it's pretty great actually. Yeah, I've been mountain biking too. Actually, I've been mountain biking every day that it's not raining.
Nice.
Yeah,
Love it. How's your outdoor renovations, Mark? They're behind you now or still going on?
No, they're still going on. They've almost got the deck done. A lot of it's like, I'd say we're like 75% of the way there. So when I get back from my trip, everything should be done and complete. It's looking great. They're doing a great job. Yeah, I'm really excited to see what it looks like when they're all finished.
Love it. You can reach us all, of course, Twitter, LinkedIn, all the regular usual spots. Emails are always welcome. info@pwlcapital.com. I think this is the first episode we've mentioned our good friend Jason's name twice, so
He'll be very excited about that because he
didn't
recently
have his bingo
commented. The first time you guys mentioned him, I think you said an advisor we know, and then like eventually it was like our friend, and then eventually you used his first name, and I think we used his last name twice on this episode. So he's going to be very excited with the progress that he's made in getting onto the podcast.
He still jokes about that though.
I know.
You said it. It was like an advisor that we both know in Toronto, or some like vague description of him, but it was obvious who you were talking about.
We'll call him Jason.
I'm going to message him as soon as we stop recording this, and he's going to be very, very pumped.
Yeah, all the other planners are going to have to fold their names in too, I guess.
Yep.
Such a great community in Canada.
Oh yeah.
Of our people, we call it affectionately. You know, there's so many great advisors.
Yep.
They're at all kinds of different firms. They got their heart and brains in the right place. It's so impressive. It's a great time to be seeking out advisors like that.
Yep. Agreed.
So, okay. Anything else, guys?
No, I got to go right now and finish the questions up for Antoinette Shore and John Griffin, who are both episodes that we're recording when we get back from vacation, but they are going to be incredible episodes. I can already tell you that.
Yeah, and Wei Dai was great too. And by the time this comes out, our conversation with Dan will have come out. Dan Bortolotti, the Canadian Couch Potatoes, last week. And Dan was also phenomenal. Very good friend, dear colleague, and great communicator, as everyone now knows. And many people already know, because his legacy in the Canadian financial planning space is legendary almost now. Mm-hmm. Okay, guys, is that a wrap?
It's a wrap.
Yep.
All right. Thanks, everybody, for listening.